Welcome to Section 5 of PNJ Group's ASC 710 training. This section is about execution, the actual journal entries that bring the concepts from the previous sections to life. We will walk through every major scenario: vacation accrual, sick leave, termination benefits, deferred compensation, and two fully worked numeric examples you can use as reference templates. By the end of this section, you will be able to book every major ASC 710 transaction with confidence. That means accruing the vacation liability, reducing it when leave is taken, settling it when an employee departs, and adjusting it at year-end. You will also record both voluntary and involuntary termination benefits correctly and work through the three-stage deferred compensation entry sequence. Two fully worked numeric examples anchor the theory to numbers you can follow step by step. The vacation accrual is the most common entry under this standard. As employees work each day, they earn vacation time. The matching principle requires recognizing the cost in the same period. Debit vacation expense, credit accrued vacation liability. No cash changes hands at accrual. You are building a balance sheet obligation that reflects what you owe employees for time they have already earned. At period end, you reconcile the accrual to the actual HR system balances and post an adjustment to true-up, either an additional accrual if the liability is understated or a reversal if it was overaccrued. When an employee actually takes vacation, the liability is consumed. Debit the accrued vacation liability, credit wages payable or cash. Notice there is no new expense at this point. The expense was already recognized when the vacation was earned. The liability simply converts to a cash payment. The same logic applies when an employee terminates and receives a vacation payout. If the accrual was accurate, there is no income statement impact on the day of termination. The liability that had been building disappears against the cash payment. If the accrual was off, you record the difference, but ideally, your estimates eliminate that gap. Year-end is when your accrual meets reality. Pull the actual vacation balance from the HR system for every employee, recalculate the liability at current or expected future pay rates, and compare to the carrying balance. If the liability is understated, post an increase, debit vacation expense, credit accrued vacation liability. If it is overstated, post a decrease. Debit the liability, credit vacation expense, a reversal that reduces the prior overaccrual. Always reconcile at the employee level. This is how you catch terminated employees whose vacation balances were not properly zeroed when they left. Termination benefit entries follow the same debit expense, credit liability structure, but the timing is different depending on the nature of the termination. For a voluntary early retirement offer accepted by the employee, debit termination benefit expense, credit termination benefit payable on the acceptance date. For an involuntary restructuring that has met all 4 ASC 420 conditions, debit restructuring expense for severance, credit restructuring liability, but only after the plan has been communicated to employees. In both cases, settlement is a simple debit to the liability and credit to cash when the payment goes out. Walk through the numbers. 20 employees, each earning an average of $60,000 per year. That works out to a daily rate of $230.77, $60,000 divided by 260 working days. Each employee has 5 days of unused vacation at December 31. Total gross liability: 20 employees times 5 days times 230.77 equals $23,077. Add employer payroll taxes at 8%, $1,846. Total vacation liability at year-end, $24,923. That is the balance that should sit in accrued vacation liabilities on your balance sheet. If your current balance is different, calculate the adjustment and post it. Example 2 shows what the 4 criteria test looks like in writing. The policy: 10 sick days per year, unused days forfeited at year-end, no payout at termination. Apply the criteria. Criterion 1, earned by past service. Yes, employees earn sick days by working. Criterion 2, vesting or accumulating. No. The days forfeit at year-end and are not paid out on departure. Criterion 2 fails. Stop here. No accrual is required. Now flip the scenario. If the same company changes its policy so unused sick days carry forward and are paid out at termination, all 4 criteria are now met and accrual becomes required. One policy change, completely different answer. Putting the deferred compensation entry sequence together. Each year during the employee's service, accrue the obligation, debit deferred compensation expense, credit deferred compensation liability. When the employer funds the Rabbi Trust, debit Rabbi Trust assets, credit cash. If the trust holds securities, remeasure to fair value at each period end. At retirement, settle the liability, debit the deferred compensation liability, credit cash. If the trust is liquidated to fund the payment, first convert the trust asset to cash, debit cash, credit Rabbi Trust assets, then pay the employee from that cash. Throughout, the liability and the trust asset are presented separately. No offset at any point. The entries in this section translate every ASC 710 concept into accounting action. Vacation builds through the expense account and clears through the liability when used or paid out. No double counting. No new expense on the day of payment. Year-end reconciliation is your safeguard against inaccurate estimates. Termination benefit timing depends on who acts. Employee acceptance for voluntary, employee communication for involuntary. And deferred compensation always involves 3 separate entries that never get combined. Next, we move to financial statement presentation and disclosures, how all this work appears to the outside world. Thank you for completing this section on journal entries and worked examples. Thank you for watching. Subscribe for more training from PNJ Group.